To open a portfolio management service account in India, an investor must bring a minimum of 50 lakh rupees to the table. For this tier of capital, a clever trading strategy is insufficient. SEBI requires every account to be supported by a rigid, standardized operational architecture. The Securities and Exchange Board of India dictates the exact blueprint of this architecture through the Portfolio Managers Regulations of 2020. These rules exist to protect client assets, enforce fair trade execution, and mathematically lock the manager's compensation to their actual performance. This flowchart breaks down the 4 sequential stages of the PMS lifecycle governed by SEBI: pre-onboarding disclosures, daily trade execution, rigid fee calculations, and standardized reporting. Before entering this pipeline, the client chooses how the account will run. In a discretionary account, the manager makes all the decisions. In a non-discretionary account, the manager suggests, but the client must approve each trade. In an advisory setup, the manager simply provides research and the client executes the trades themselves. A PMS operates as a legally enforced fiduciary fortress, engineered to remove manager bias and protect the investor at every stage of the process. The pipeline begins with onboarding. Before any funds are transferred, the firm must execute mandatory Know Your Customer protocols, verify the investor's PAN card, and run strict anti-money laundering checks. Clients also hold a regulatory right to direct onboarding. This guarantees an investor can bypass distributors entirely, opting to invest without paying any third-party intermediation fees. Once verified, the client receives the foundational regulatory text, the disclosure document. This document is split into 2 halves. The static section details the firm's history, the exact services they offer, and any past regulatory penalties they faced. The dynamic section provides the firm's latest audited financial performance and a complete log of any transactions executed with related parties. Because critical details vanish inside dense legal text, SEBI mandates a summary document, the standard MITC. The client explicitly acknowledges specific fields here, including exact fees and charges, the chosen benchmark, and personal risk tolerance. Signing this page legally binds the portfolio manager to follow a highly specific investment approach. These standardized onboarding documents reduce information asymmetry, clarifying the manager's approach and fee structure before any capital is deployed. Once the paperwork clears, capital moves into the active market phase, trade execution. This schematic outlines the dealing room, a secured environment digitally and physically isolated from the corporate office. No mobile phones are permitted inside this boundary. All trade orders must flow exclusively through dedicated, recorded telephone lines and authorized email addresses. These communication blackouts exist to prevent insider trading, stop employees from front-running client orders, and preserve a documented audit trail for regulators. For large PMS firms, specifically those managing over 1,000 crore rupees, the rules become even tighter. These massive entities are legally required to use an automated order management system, ensuring minimal manual intervention. By utilizing strict timestamping on every order, the system mathematically enforces fair, pro-rata trade allocation across all client accounts. The dealing room firewall strips human bias out of daily execution. It ensures that whether a client has 50 lakhs or 50 crores, they receive the exact same entry and exit pricing. After the trades are executed, the system turns to the most heavily scrutinized part of the life cycle: fee extraction. SEBI strictly prohibits PMS providers from charging any upfront fees. There is also a hard cap on operating expenses. These costs cannot exceed 0.50% per annum of the client's daily average assets under management, excluding brokerage and statutory taxes. To generate significant revenue, managers rely on performance fees, which reward them for generating positive returns. This chart illustrates the high watermark principle. It's a strict mathematical rule designed to prevent managers from double-dipping on fees while a portfolio merely recovers from a loss. If a portfolio gains 15% in its first year, the manager earns their fee. The dotted high watermark line rises perfectly in tandem, setting a new peak. Watch what happens in year 2 if the portfolio suffers a 10% loss. The asset value drops, but the high watermark remains fixed at the previous peak. During this entire downturn, the manager earns 0 performance fees. In the third year, if the portfolio recovers, performance fees only trigger after the line crosses above that fixed high watermark. Many portfolios also utilize a hurdle rate. This sets a baseline percentage, like 10%, that the manager must beat before any performance fee kicks in at all. These mathematical constraints ensure that the portfolio manager only profits when they generate actual new wealth for the client. The final stage of the operational loop ensures ongoing transparency, reporting, and compliance. Portfolio managers must formally report performance metrics to the client at least once every 3 months. Managers might manipulate data, timing cash flows perfectly to make a poor fund look highly profitable. To prevent this, SEBI mandates the time-weighted rate of return, or TWRR. It strips out external cash deposits, revealing the true performance of the manager's decisions. Firms also report the extended internal rate of return to provide a comprehensive view of the overall investment approach over time. For debt securities, managers cannot value the assets themselves. They are strictly required to use independent APMI impaneled valuation agencies to price the portfolio. Even with systems in place, disputes happen. The redressal pipeline begins with the firm's internal compliance officers. If unresolved, it escalates directly to SEBI's centralized Scores 2.0 system. The ultimate resolution mechanism is the Smart ODR portal, mandating binding online arbitration outside traditional courtrooms. From MITC onboarding to the ODR portal, this framework enforces a transparent lifecycle. A manager's success now depends entirely on actual, documented fiduciary growth.